Welcome to The Explainer. So today, we're diving into the absolute lifeblood of the global economy. And to really get our heads around this, I want you to imagine the world's financial system, not as, a bunch of boring spreadsheets, but as this giant, bustling, heavily interconnected city, right? And for any city to actually thrive and expand and innovate, it needs a continuous, high-speed flow of resources. In our city, that resource is money. But how exactly does it get from the people who have it to the people who desperately need it? Well, that is exactly what we're going to uncover today. Okay, let's map out our tour really quickly. First up, connecting savers and dreamers. 2, exploring the market neighborhoods. 3, the financial bodyguards. 4, the great storm of 2008. And finally, 5, the new financial era. Let's get right into it. Part 1, connecting savers and dreamers. So, for any major urban center to grow, it absolutely needs a reliable water system to make sure resources are flowing across every single neighborhood. In our financial city, money is that vital infrastructure. To build the future, the money literally has to move. On one side of town, we have the suppliers of funds. That's you, me, everyday people putting away cash for retirement or just saving for a rainy day. Basically, we have extra cash. Now, on the other side, we have the users of funds. These are the corporations, the governments, the visionary dreamers with massive ideas, like, say, building a huge new factory or researching a breakthrough medicine. But here's the catch. They don't have the cash on hand. Financial markets act as the bridges connecting these two sides. Okay, so how does that transfer actually happen in the real world? Let's walk through the timeline. First, the users of funds realize they need capital. Obviously, they can't just go out on the street and ask for $1 billion. So step 2, they go to investment banks for underwriting. This is essentially getting high-level professional help to create financial instruments like stocks or bonds. Then, in step 3, the initial suppliers, again, that's our everyday savers, buy up those brand new instruments. And finally, step 4, at some point, those initial buyers might actually want to sell their instruments to other investors. And that moves us right into what we call the secondary markets. Let's break those steps down a bit, starting with primary markets. This is where users of funds raise their capital by issuing brand new financial instruments. Think of an initial public offering, or IPO. When you buy a security in the primary market, your money goes directly to the company that issued it. It is exactly like buying a brand new car straight off the assembly line. The factory gets your cash directly and they use it to fund their operations. But what happens when you want to sell that stock a year later? You don't take it back to the company, right? You sell it to another investor. And that entire exchange happens in the secondary markets. Think of this as a massive, high-speed used car lot. Now, the original company doesn't see a single dime from this trade, but man, these markets are incredibly important. Why? Because they provide liquidity. That means you can turn your investment back into cold, hard cash super quickly. Plus, they provide vital price information, so everyone knows exactly what a specific asset is worth on any given day. Part 2, exploring the market neighborhoods. Now that we know how the bridges actually work, we really need to figure out where they lead. We generally divide our financial city into 2 main zones, basically based on time. First up is the money market. Think of this as the short-term district. Everything here is incredibly fast-paced, but very highly structured. It deals exclusively with short-term debt that matures in 1 year or less, stuff like U.S. Treasury bills. It's a very safe neighborhood, very low price fluctuations. But on the flip side, we have the capital markets. This is our long-term district. It trades in long-term debt and equity, like 30-year mortgages or corporate stocks. Naturally, this neighborhood experiences much wider price fluctuations. So yes, it's riskier, but it is also where the absolute biggest growth and wealth generation actually happens. And if we look at the estimated composition of this capital market district for 2025, corporate stocks just absolutely dominate the landscape. They make up a whopping 50.7% of the entire capital market. That's followed by Treasury securities, sitting at 23.9%, and mortgages at 11.4%. Rounding out the rest of the pie, we see corporate bonds making up 7.3%, and some other varied assets taking up that final 6.7%. Basically, when we're talking about the health of long-term investments, we are overwhelmingly talking about the performance of corporate stocks. Part 3, the financial bodyguards. So up to this point, we've talked about direct connections between savers and users. But let's be real for a second. Most people are naturally pretty afraid to just lend their hard-earned money directly to complete strangers. And rightfully so. Just consider the sheer danger of direct lending. Say you loan a random company your entire life savings directly. You instantly face huge monitoring costs. You would literally have to personally audit their books to make sure they aren't lying to you. Plus, you'd face liquidity constraints. Like, if you suddenly need cash for a medical emergency, you can't exactly just demand your money back from that company overnight. And of course, you'd face massive price risk. If that single company just happens to fail, it is just way too dangerous for the average person. And that brings us to our big solution. Financial institutions, or, what I like to call our financial bodyguards. Instead of lending your money directly, you put it into commercial banks, thrifts, insurance companies, securities firms, finance companies, or investment funds. These institutions essentially act as asset transformers. They take your small, totally safe deposit and they combine it with millions of others to make really big, inherently risky loans to corporations. They absorb that price risk, they completely guarantee your liquidity so you can pull your cash out anytime, and they do all that expensive monitoring for you. They basically make the city safe for the everyday saver. Part 4, The Great Storm of 2008. But as we know, bodyguards aren't invincible, and even the strongest infrastructure can crack. To truly understand today's financial city, we kind of have to look back at the absolute climax of its history, a moment when the entire system genuinely nearly collapsed under its own weight. See, for decades, banks used an originate and hold model, meaning they made a mortgage loan and they held onto it for 30 years. Because of that, they were very, very careful to only lend to people who could actually pay it back. But then the industry shifted. They moved to an originate and distribute model. Banks started making loans and then pretty much immediately selling them off to other investors. Because they weren't keeping the loans on their own books anymore, they suddenly completely lost the incentive to rigorously check the borrower's quality. And this shift is what allowed highly risky, toxic subprime mortgages to be heavily distributed, essentially infecting the entire plumbing of our financial city. And once that infection set in, the disasters came in incredibly rapid succession. In late 2006, the previously booming housing market suddenly just plummeted. By July of 2007, foreclosure filings violently jumped 93% compared to the prior year. The panic completely spread through all the institutions holding these bad loans, and it climaxed in September 2008, when Lehman Brothers, a massive, massive investment bank, filed for the largest bankruptcy in history. The credit markets totally froze. Literally no one would lend to anyone. By October, the government had to step in with a massive emergency rescue plan. The cost of that rescue plan? $700 billion. I just want to let that number land for a second. $700 billion. The Troubled Asset Relief Program, or TARP, was designed to let the U.S. Treasury buy up those toxic mortgages just to unfreeze the credit markets. It was an absolutely unprecedented structural intervention, and it was done to stop the complete and utter destruction of the global financial city. Part 5, The New Financial Era. Following the rubble of that great storm, the city obviously had to rebuild, but it definitely couldn't be rebuilt the exact same way. We entered a totally new era characterized by much stronger rules. And this really started with derivatives, which, if you don't know, are essentially financial betting slips whose value is linked to another underlying asset. Back in 1992, banks held about $8.7 trillion in derivatives. By 2008, that number had ballooned to $203 trillion, and it eventually peaked in 2013 at over $231 trillion. But take a look at 2021. It actually dropped back down to $177.4 trillion. Why the huge drop? Because post-crisis regulations, specifically the Volcker rule that was implemented in 2014, clamped down super hard on banks making these highly speculative, incredibly risky trades. It forced a massive decline just to make the whole system safer. This rebuild also fundamentally changed how institutions actually operate day to day. First off, we saw the huge rise of enterprise risk management, or ERM. Instead of looking at risks in isolated little silos, financial institutions now look at the whole picture to see exactly how all risks interact across the entire firm. Second, the tech-savvy fintechs arrived on the scene. They're using cryptocurrencies, blockchain, and peer-to-peer networks to bypass traditional banking entirely. And third, globalization. With the rise of the euro and deregulation in emerging markets, investors sitting in a coffee shop in New York can instantly fund a factory in China. The city limits are literally being redrawn as we speak. And just to show you the staggering scale of what this interconnected global system has actually become today, the overall assets of United States financial institutions alone have grown to $79.08 trillion. That is an almost unfathomable amount of capital flowing through those primary and secondary market bridges we talked about, guarded by these massive institutions and overseen by global regulators. Which really brings us to our final takeaway. Money must flow for the world to work. It truly is the water system of our entire society. But because that flow is inherently full of risks, we rely heavily on institutions to guard it, regulators to watch it, and new technology to keep it moving faster than ever before. But, as fintech continues to blur the traditional lines of banking, it leaves us with a pretty provocative question. In the financial city of tomorrow, will we even need these traditional bodyguards? Or will technology eventually allow every single everyday saver to safely fund the dreamers themselves? It's definitely something to think about. Thanks for joining me on this explainer, and keep learning.